Wednesday, December 7th, 2022, Maneco 64, home of alternative economics and contrarian views. Today we're going to look at how Russia could peg the barrel of oil to the gram of gold in order to circumvent the price cap that the West or the EU is putting on Russian oil. And that's not me saying it. That's Zoltan from Credit Suisse. Before we look into that in more detail, I just saw a fresh headline: China retreats from sweeping zero COVID policies as economic toll mounts. That's just come out in the FT. I like to say as well that this video is sponsored by the Gold Coin Balance. You can use the Gold Coin Balance to test the most popular 1 ounce gold coins like the Philharmonic, the Maple Leaf, the Buffalo, the Panda, the Kangaroo, the Eagle, and the Krugerrand. So if you're interested in the Gold Coin Balance, there's a link below in the description where you can get one. And they also have a guarantee, which is send us a fake coin that passes the 3 tests and we will pay you gold's spot price. So there you go. Back to Zoltan. He's very widely followed, and I saw some tweets last night. Can I have Zoltan's PDF? Because he writes something for his clients and it comes out, of course. I think Zero Hedge has it, but if you're not a premium member, you can't get into the Zero Hedge article. I found a tweet where the whole newsletter or research piece that Zoltan wrote is there. I've read through it, and I'm gonna put it up here right now, all 4 pages, screenshot. And if you want, you can pause this video and do your own screenshot and read it yourself. I've read through it, of course. So first of all, let's see who Zoltan Pozsar is. I went to the Credit Suisse website. He's global head of short-term interest rate strategy at Credit Suisse. So this is his background. Prior to joining Credit Suisse in February 2015, Mr. Pozsar was a senior advisor to the U.S. Department of the Treasury, where he advised the Office of Debt Management and Office of Financial Research and served as the Treasury's liaison to the FSB on matters of financial innovation. Mr. Pozsar was deeply involved in the response to the global financial crisis and the ensuing policy debate. He joined the Federal Reserve Bank of New York in August 2008 in charge of market intelligence for securitized credit markets and served as a point person on market development for senior Federal Reserve, U.S. Treasury, and White House officials throughout the crisis. Played an instrumental role in building the TALF to backstop the ABS market, pioneered the mapping. So you get the picture. This guy has all the qualifications, much more than I do. And now he's saying, I've read his latest piece, that the problems we had in 2018, 2019 to do with QT, when the Fed running off its balance sheet, and the repo crisis in 2019, that's not possible anymore because the huge reverse repo balances that we have in the system now make it so that a funding problem in that sense is not possible. He notes that JP Morgan, of course, ran out of reserves back in 2019, and that's why the repo crisis kicked off in September, I think it was. And repo rates, overnight lending amongst banks shot up from around 2% to 10%. He said that's not a problem anymore. For him, the most important problem right now that could disrupt things, and especially for the big bullion banks, is the commodity markets, and specifically oil and gold. And why oil? Well, because he says oil is the equivalent to the excess reserves in the financial markets, and unfortunately you can't print oil out of thin air, and oil supplies are dwindling. The OPEC countries' production is not increasing. And he says that the only reason why oil hasn't gone up this year is because the U.S. and the administration have released crude oil from the strategic petroleum reserves. And he says that those reserves could dwindle to nothing. And the worst case scenario is that they run out by April if the U.S. decides to release 3 million barrels a day for the next 3 months. There's only 400 million barrels left in the reserves. And he talks about the price cap for Russian oil at $60 that the EU's imposed on Russia. And how India, though, is circumventing that, getting the Russian oil and processing it into diesel and making a profit. That's called the crack spread. You buy crude oil and you refine it into diesel, and you make a profit. That's the crack spread. That's what it's called. And yeah, so what he's noting here is, would Putin be happy to see his crude oil, the Urals crude oil, that is, flow indirectly through India and into the U.S. strategic reserves at $60? No. So this is what Zoltan says that Russia could do. Hot wars and cold places also involve corridors of power that determine who gets the use cutting-edge technologies, the U.S.'s technology blockade of China, who gets paid how much for commodities, the G7's price cap on Russian oil, and how commodity trades get settled, Moscow's demand for to get paid in gold as an analog to Moscow's demand this year to get paid in rubles. War is not about gentlemanly conduct. The cap of $60 per barrel for Russian oil equals the price of a gram of gold at current market prices. Let's imagine this setup as a peg. The G7, led by the US, effectively pegs the US dollar to euros at $60 per barrel. In turn, Russia pegs euros to gold at the same price, a gram of gold for the barrel of euros. The US dollar effectively gets revalued versus Russian oil, a barrel for less. The Western side is looking for a bargain, effectively forcing a price on the OPEC plus, on the plus. That's Russia. But if the West is looking for a bargain, Russia can give one of the West's, can't refuse a gram for more. If Russia countered the price peg of $60 with offering 2 barrels of oil at the peg for a gram of gold, gold prices would double. Russia won't produce more oil, but would ensure that there is enough demand that production doesn't get shut. And it would also ensure that more oil goes to Europe than to the US through India. And most important, gold going from 1800 to close to 3600 would increase the value of Russia's gold reserves and its gold output at home in a range of countries in Africa. Crazy? Yes. Improbable? No. This was a year of unthinkable macro scenarios and the return of statecraft as the dominant force driving monetary and fiscal decisions. I am often asked about the next LDI blow up. That's a reference to the UK pension market that almost blew up back in September, October time. And this is what he says. Those questions are missing the point. The lesson about the mini budget and the gilt sell-off that followed is that states sometimes do irresponsible things or things that seem responsible but may backfire. Russia's decision to link gold to oil could bring gold back as a settlement medium and increase its intrinsic value sharply. Banks active in the paper gold market would face a liquidity shortfall as all banks active in commodities tend to be long OTC derivatives, receivables, hedged with futures, an asymmetric liquidity position. That's a risk we don't think enough about and a risk that could complicate the coming year-end turn, as a sharp move in gold prices could force an unexpected mobilization of reserves and expansions in balance sheets and risk-weighted assets. That's the last thing we need around year end. And he says as well, Basel III was designed to keep banks from doing things that could hurt them. But as the mini budget has shown and Russia's response to the cap might show, Basel III won't protect from states doing things that could end up hurting banks. Just as the German industrialist who built a successful business over a lifetime and outsourced only one thing to the German government, energy security, banks have been managing their paper gold books with one assumption, which is that states would ensure gold wouldn't come back as a settlement medium. So that's very important. And I've been talking to you about paper gold for years, that it's something waiting to blow up eventually. And I think President Putin knows about this situation because one of his economic advisors went to one of GADA's gold rush conferences in the Klondike back in 2005. They know all about the paper game in the gold market. So let's look at the markets now. It's 8:45 a.m. London time. The stock markets continue to drop yesterday. I think the Dow was down about 1%. S&P and NASDAQ a little more. And I was encouraged by the performance of gold and silver. Gold held very well, unchanged to slightly higher. Silver dropped a little bit, but not that much. So right now we've got gold at 1773. It's up $2. High's been 75, low 66. Spot silver is up about 0.5% at 22.30. Low's been 22.07. High 22.41. The stock markets are virtually unchanged here, so I won't go through them. The futures, the currencies as well are pretty much unchanged. We've got the dollar up about 1/3 versus the yen, but versus the pound and the euro, everything's like flat for the day. We've got the Chinese yuan. The dollar is unchanged as well at 697.70. Let's quickly look at the ruble, see what the dollar is doing versus the ruble. It's trading around 63, so pretty much unchanged from yesterday as well. And the other currencies, Aussie dollar is down slightly, 66.80. Dollar's up 0.2 versus the Canadian dollar, 136.75. And the Kiwi dollar is up 0.1 at 63.30. To the general commodities, WTI crude is down 0.75% at 73.85. Brent crude is down 2/3 at 79. High-grade copper is down 2/3% at 379. And U.S. nat gas is up 3.6% at 564. Let's check the Dutch TTF nat gas futures. That's up 1.2%, trading around 140. So let's see where the bond market is. Check the treasuries, 10-year treasury. That's at 352. That's up 1 basis point. So I think we closed just below 350 last week. So it's pretty steady, the 10-year yield. And before I finish, yes, it's interesting that what Zoltan talked about is that it could create a lot of havoc in the bullion bank and the too big to fail banks. This possible move to peg the barrel of oil to a gram of gold by the Russians.